Welcome to the fourth of 8 webinars in a series covering each of the levers in Equiteq's equity growth wheel. Today we'll be talking about quality of fees. My name is Pat Webb. I'm a client growth director and I'm based in Vancouver, and I'm going to be your host. I'll be speaking with my colleague Paul Beaumont, who's in London, and we'll explore the topic together for about 20 minutes. Then for the last 10 I'll be putting your questions to him. So please post your questions using the control panel on the right hand side of the screen as we go. The question box appears just towards the bottom. At the end of the webinar, we'll be giving some homework to do, which will help you improve the quality of fees that you're earning. So please do hang around right to the end. So, Paul, perhaps you could begin by telling us what's the most important message about the quality of fees lever?
Yeah, hi Pat, and hello everyone. You probably know the expression, I never met a dollar I didn't like. And when you're a startup consultancy trying to get work, that's exactly how it feels. You need all the fees you can get. This lever, however, is all about the need to transition away from this startup mentality so that you consider the quality of fees and not simply the quantity. This is important not just so that you can grow your business more effectively, but also because potential buyers of your firm will look carefully at the type of work you're winning. So in order to grow in a controlled and sustainable way and reduce your risk in fee income and make it predictable. That's the key message.
Okay, thank you, Paul. Before we dive down into the detail of the subject, let's quickly remind ourselves where quality of fee income fits within the overall context of growing and developing your firm. Those of you who've heard our previous webinars will be very familiar with this diagram, and for those of you joining us for the first time, this picture represents a high-level view of all the operational issues that a buyer of a consultancy will look at to identify how risky it would be for them to buy your firm. Now, in a 20-30 minute webinar, we're obviously not going to be able to give you a lot of detail, a quick skim through, but one of our clients describes this model as a way to make sense of the madness. It clarifies all the levers that you need to pull to drive sales and profit and equity growth. So Paul, can you give us some of the highlights from the quality of fees lever?
Yes, certainly. I've already said that the key message here is that you need to reduce your risk in fee income and make it predictable. Why? Because a balanced portfolio of clients with predictable revenue supported by good cash collection gives confidence to potential buyers. And of course, it makes sense for you now, no matter when you intend to sell. So there are three main elements to this lever. Firstly, reduce risk to revenue forecast. Secondly, manage cash so that growth is not constrained. And thirdly, balance capacity with demand. You can see that the first of these elements contains 4 recommendations, each of which we will explore. Focus your services on a limited number of sectors, engage with a balanced portfolio of clients, sell more of what you currently do to people you already know, short-term one-off projects into integrated programs. So let's have a look. In order to focus your services on a limited number of sectors, you should begin with a simple piece of analysis which we call the service market matrix. Not many consultancies actually do this, but it is very useful diagnosis. Let me explain the structure using this fictitious example. Across the top of the matrix we have the 6 services that the firm offers, and down the left-hand side you see the market sectors where they operate. They have analysed which services they have delivered to each of their clients, along with how much revenue they have earned from them, and then grouped their clients into sectors. The data in the table, therefore, is simply the revenue earned by each service in each sector. And what's immediately obvious in the matrix is there are a lot of gaps, the revenue is clustered, and there are many sectors. This means that they are probably stretching themselves too thinly. It's difficult to have domain expertise in every sector, and besides, 4 of the sectors contribute less than 5% of their revenue. They would be much better off concentrating their efforts on a smaller portion of the market. They may also want to consider how many services they can genuinely offer and would actually be really good at. So the message to this client at their current stage of growth would be less is more.
Yeah, this is a really important piece of analysis, and it's something that we encourage all our clients to do. And I'd just like to underline the link to quality of fees. One of the secrets to growth is focus, because the greater your domain expertise, the more value you can add to your clients, and therefore the higher fees you can charge. And more than that, once you've established yourself as the go-to consultancy in your focused area, the more clients will come to you and the more predictable will your revenue be. So, Paul, we've discussed the need to focus services and sectors. What are your recommendations for focusing on clients within a sector?
Well, in a way, the advice is the very opposite, namely, don't allow too much concentration. If you have all your eggs in one basket, then your business is at risk. We've worked with several businesses where more than 50% of their revenue was with a single client. Now, if for any reason they lost the client, then obviously half their business would disappear. This is not as unusual a situation as you might think, especially for small growing consultancies, and as you can imagine, a potential buyer would run scared of acquiring a business with that sort of risk.
Yeah, as you know, Paul, I live in the Pacific Northwest, and in this part of the world, Microsoft uses a lot of contractors. So there's loads of small growing consultancies here. Unfortunately, in July last year, 2014, Microsoft announced that any contractor that had worked for them continuously for 18 months had to terminate their engagement for 6 months. Now, this resulted in a mighty scramble by these firms to find replacement revenue, and it was no fun.
Yeah, I'm sure it wasn't, Pat. They would have been better off with a profile more like the one on the right-hand part of the screen, where their revenue and risk was more broadly spread.
Well, it sounds really good. How would you actually do that?
Well, here's a useful tool which will help you, and which we actually talked about in our last webinar on the client relationship lever. This is the next level of granularity from the service market matrix. It's the service client matrix. It shows the revenue you've earned by service by client. The white spaces in the table represent opportunities to cross-sell your services to people you already know. And for this reason, this approach is sometimes called white space analysis. As I mentioned earlier, you want to maintain a balanced portfolio of clients, and this tool helps you see at a glance both the opportunities for growing revenue and the risk of any single client dominating your income.
And I remember, Paul, when we talked about the webinar on sales and profit growth, the key message was that buyers of consultancies want to know how well you can keep your clients and sell on into them.
Yes, exactly. And the message of this lever is that you need to reduce risk in your revenue and make it predictable. And one way in which you can ensure you keep your clients and make your revenue more predictable is by turning short-term one-off projects into larger projects and then into integrated programs. The analysis of project size, which is shown here, gives you a very valuable insight into the size of your engagements. You need to make your offerings more sticky so that you continue to deliver value for longer. From the example shown here, it looks like the company has a lot of work to do in that respect because they have a very long tail of very small projects, although they're obviously capable of selling larger ones as well.
Yeah, I like this last point, Paul, and I'd like to tell a quick story about a client of ours that succeeded in making their offerings more sticky. This was a firm, is a firm in the human capital space, and they used to offer one-off training packages, which led to short-lived engagement. In other words, one and done. So to address this, because they had this huge long tail, they repositioned their services so that they aligned with large change programs that their clients were delivering, so that they became an integral element of those programs. Now, that meant that instead of selling discrete pieces of work, the one and done approach, they were now being engaged for a year at a time. And incidentally, the client benefited hugely from this new model because their own change programs started to succeed at a much higher rate than before.
Yeah, thanks for that, Pat. That's a good example of how to reduce revenue risk. Now, let's go to the second element in this lever, which concerns cash. The message is that you need to manage cash so that growth is not constrained. There are 4 things you can do to stay on top of this. Number 1, as a rule of thumb, try to have 3 months of cost as cash in the bank and invest the rest for growth. In other words, if your revenue stopped immediately, you'd be able to keep going for 3 months. If you're still very small, you might feel more comfortable with enough cash to cover 6 months' cost. But remember, while the cash is sitting in your bank, it's not helping you to grow. Whatever is right for your business, you need to ensure you have a good visual dashboard that tracks actual performance against target. Number 2, make sure your terms and conditions are favourable to you. Now, this may seem difficult for a small consultancy that's serving a large client, but there are a number of strategies you can deploy. For example, invoice at the start of the month for fixed fee projects and true up at the end of the program. Get staged payments that run ahead of the work delivered. It may be possible to invoice, say, 30 to 40% of a project at the start of the engagement. And separate expense invoices from fee invoices. This prevents the payment of a large fee invoice from being delayed because of a trivial dispute over an expense item. Number 3, measure your debtor days and closely monitor clients that have not been paying on time. And number 4, find out when the client payment runs are and make sure your invoice is due to be paid before the run takes place to be certain it's really going to happen. Often the on-site project managers are in the best place to do this because they can form relationships with the right people and smooth the payment problems before they arise. Now, needless to say, managing the cash so that growth is not constrained is not just good for your business now, but it is also evidence to potential buyers of good management and control.
Mm-hmm. And you mentioned, Paul, about consultancies that deal with very large companies. Often they have standard payment terms of 60 days, regardless of a consultancy's preferred terms. How would a buyer view that?
Well, to be honest, Pat, buyers want to see good control of cash. So if payments are being made in 60 days because those are the terms rather than because of poor cash control, then that's not really a problem. So finally, the third element of the lever deals with the issue of balancing capacity with demand. This simply means having the right number of delivery resources available. Too few means you lose revenue, too many means you lose margin. Now, owners of consultancies are understandably wary of recruiting people in busy periods only to find that the increase in demand doesn't last, leaving them with the heavy cost of underutilized employees. Although this critical decision-making process can never be an exact science, after all, forecasts are only ever wrong or lucky, you're more likely to make the right decision with good information than with bad. There's quite some detail on this slide, so we'll go through it a bit at a time because these are tools that can help you. The graph in the top left-hand corner shows the demand plotted at the end of the month of May. The revenue includes all booked work plus good and hot prospects. There are no prospects in May or earlier because in this example, that's in the past. When you do this for your business, you should discount your prospects to reflect the probability of them converting, but don't get carried away with trying to be too precise about probability. We recommend simply using two buckets. Hot prospects are those where your client has given you a strong indication that they will engage you, but you don't yet have the order, and discount those to 65% of their value. And good prospects, which are those where you have submitted a proposal, there's a real project with a budget, but it may be competitive. So discount those down to 35%. All other prospects should be valued at 0. Now, when you look at the forecast, you can map it against your capacity. The example shows capacity of 100,000, which seems a bit light for the next 3 months because, as you can see, demand may well be more than that. Now, that gap could be filled with subcontractors, but if the sales pipeline grows much more, then the business is likely to start to creak. Incidentally, you can analyze the same data cumulatively, as shown in the bottom left-hand graph, and use it to compare your performance against budget for the year. The example shows a gap between budget and forecast, which should focus the mind on sales.
Yeah, and it's a perfect time, Paul, to ask a question that someone posed when they registered for the webinar. The revenue profile shown in the graph looks relatively healthy, but there's still quite a bit of variation in it. And the question we've been asked, which we get asked all the time, is how do you smooth out the revenue line to overcome the feast and famine issue?
Yeah, this is a very common problem in consulting. It occurs because the same resource that does the selling also does the delivery. So when they're delivering, they don't sell and the pipeline dries up. And this is particularly acute when the business is small because there are fewer resources and, of course, even minor fluctuations in demand have a big impact. The more you grow, the easier it becomes to manage the noise. I think the key is to ensure that your sales effort does not become diluted by delivery. Keep sales focused on selling and steadily building a future pipeline. However, no matter how good you are at increasing sales, demand will never be completely smooth, which begs the question of how to manage your capacity. For our clients who are already tracking their revenue pipeline in the way we've shown on the left, we sometimes suggest an additional tool called a pipeline index, which casts light on the demand capacity balance. To do this, you need to calculate your delivery capacity at full sales value, making assumptions about utilization levels and day rates, and divide this number into the discounted sales value. If the index is 1, then your capacity and demand are perfectly matched. The higher the index above 1, the more stretched your resources will be, and below 1 means you have insufficient demand. Again, don't get carried away with the arithmetic. It's useful information to help support an informed decision. And when you look at your utilization analysis, and there's a hint here, you should measure it, you might find that there's some rebalancing required to get more out of underutilized people and perhaps relieve the pressure on those who are too busy, and this is what the graph in the bottom right-hand corner shows. However, as I mentioned earlier, you can also temporarily plug any shortfall in resource with properly qualified subcontractors. You must make sure, though, that you get a blended rate of 50% gross margin so that you don't make working with contractors too costly.
It's a very interesting point about subcontractors. Paul, can you tell us, would potential buyers of a consulting firm look down on the use of lots of subcontractors?
Well, only if the core competence of the business was locked into the subcontractors and owned by them rather than by the company. When generally speaking, buyers understand that subcontractors can be a very cost-effective way of managing the variation in demand.
Okay, well, thanks for that. We've now reached the part of the webinar where I get to ask you the questions that people have been typing up and sending in. The first one is, we only ever have 3 months of forward load. How would a buyer view that?
Well, I think a buyer would probably see that as too much risk. They're only going to invest in your company to make a good return, and if you haven't managed to create a sales engine and a proposition that gives you more than 3 months visibility, they would be likely to go elsewhere. Having said that, buyers understand that most consultancies have a short forward load relative to many other organisations, and so would not be put off unduly with something in the order of, say, 9 to 12 months.
Right, that's about creating programs rather than the one and done approach.
Yes, indeed.
Got it. Another question about subcontractors, Paul. What's the right balance of subcontractors to employees?
Well, there isn't a precise numerical answer to this, Pat. As I said before, you need to be careful that the core competence of the business remains with your employees rather than the contractors. And as a general rule, I'd make sure that the key relationships with your clients were not in the hands of contractors. Now, normally you make a lower margin on contractors, so if your average margin across the board was dropping below 50% because it was being diluted by contractors, then maybe that's a signal that it's time to consider a rebalance. Maybe by then you are using too many subcontractors.
Mm-hmm. It's a perennial problem in a business, isn't it? This, capacity and demand and getting it right. Yep. I'm not surprised we're getting lots of questions about this. Another one on a slightly different topic. We find it difficult to get utilization up across all our consultants. Any tips?
Well, you might be surprised how often we find the most senior members of a consulting firm, including the founders, are actually engaged in delivery. Well, it's no wonder that the junior staff are underutilized if the seniors are hogging all the work. There's a military imperative that says you should delegate as much as possible to the lowest rank possible, and I think that's quite good advice for consultancies too. And to do this, you have to be very good at training your staff, both throughout all levels and across the skill sets necessary to deliver your services. And of course, to be good at training, you have to have codified your IP, understand it and learn it. And in fact, Pat, IP is the subject of our next webinar, so people will be able to pick up some useful tips then.
Yeah, absolutely. And the one after that, I believe, two after that will be about the management of consultant loyalty. So we'll pick this topic up again over the coming weeks. Our time's almost up. I'm just looking at the time here. Can we switch, Paul, the recommendations? We said at the beginning we would offer some homework. What would we advise listeners to do to improve quality of fees, incomes starting right away?
Okay, well, as always, we recommend a start, stop, and continue. I think you can start getting better monthly visibility of your future pipeline and matching it with capacity. I think you can stop trying to sell everything to everyone, and I think you can continue to work within your existing sectors in order to grow new clients and avoid having all your eggs in too few baskets.
Right, well, we've come to the end of our time. We'd like to thank everybody for listening, and we have more information available at our Equiteq.com resources. We also would invite you to join our Equiteq Edge club. That's free with lots of other resources. And if you have anything on your mind about this webinar or some of the others you heard, or anything about how you would need advice on how to grow and sell your consulting firm, we would love to hear from you. And our contact details are above. Thank you for listening, and we look forward to seeing you next week. Bye-bye.
Bye-bye.